everybody. So welcome to September. Happy Labor Day. And well, I forgot a little bit of the audio thing, so I'm going to be a little bit closer and be a little bit, closer to the screen and so you guys can hear me. So first, hope you guys have a great Labor Day weekend. This is going to be super short. We're going to go over basically what happened in August. Was it a good month? Was it a bad month? What should we expect? And then more importantly, what are we looking for as far as with the September market? Where are we going to go? What should we see between now and the end of the year? So remember to subscribe. It's completely free. We don't ask you for anything. And the best part is it gives you real-time information. So make sure you subscribe, hit the bell, ask us questions by subscribing. Hey, you're letting us know that you like what you hear. That's what's really important. And then make sure you share it with anybody that you know that's looking for real-time information. So let's get to it. All right, so first, the month of August is historically kind of a mixed bag because from July 4th to about the middle of August, we actually have a pretty aggressive market, and we did. However, as we get towards the end of August, we have last-minute vacations. We've got people that are going back to school, and with that, we need to make sure that we keep the seasonality of what our real estate market is doing in perspective, because it is a normal time to slow down. And we've actually seen that, which is, well, normal. So the key thing about understanding the real estate cycles allows you to make the best decisions. As an example, right now is the best time for buyers to be out in the market because, well, other buyers are gone and people are thinking about other things. So our market times are a little bit longer. Our inventory increased just a tiny little bit, not much, but a little bit. And so therefore you have more opportunities with less competition. However, for sellers, well, it's a little bit slower. Buyers are out doing their thing. Some other sellers are not coming on market, but not unexpected. It will kick up again mid to late September as things settle out, last minute vacations, as fall, winter starts kicking in. And then real estate becomes top of mind till about the middle of December. So when we take a look at this, so year over year, our inventory is down just 6%, which this is totally expected, right? It used to be 42%, 48% in January, but we weren't comparing crazy market to crazy market. Now we're getting down to really a little bit more balance, from year over year, crazy market to crazy market. Same as new on market's actually up 11.3%. However, we come down here in the last 7 days, we only had 1,019 actually come on market, but we had over 2,000 go off market, go pending, meaning a buyer and a seller agreed to terms and closed yet, unlike the 1,908 homes that actually physically closed. So we're down about 900 homes coming on market from prior months, which is our hotter spring market, first part of the summer market, and it'll taper off and then boom, it'll pick back up again. So understand, we are still suffering an inventory shortage issue, all right? So when we take a look at pendants are up, so year over year up 11.4%, solds are up 20.5%. Now, when we take a look at month over month, these numbers aren't going to matter a whole lot except for we talk about momentum. Momentum in August, these numbers were all less inviting. How's that? But it wasn't unexpected. So inventory again, month over month, and granted it's only the 3rd of September, okay? Up for inventory, down on pendant, and down on actual closed sales. That's only the 3rd, okay? But these numbers are gonna be a little bit more consistent as far as pattern. The key thing here is to look at and notice that, again, as we have seen since May of 2020, the pendant are mirroring what new inventory is coming on market. So if new inventory is coming up, pendants are going up with it, and it's just following it because there's so few homes. And it's crazy because we should have 4 to 6 months of inventory for a healthy balanced market, and we're at 2 weeks. So we're not even at 1 month. We're still at 2 weeks. And in some areas, 7 days of inventory. There just isn't enough homes on market to make this make sense. All right. So when we talk about mortgage rates, which is going to be one of the biggest drivers next to inventory. So rates are holding at 3%. So Marie's going to post a couple of screenshots. One of them that we took off the Freddie Mac site, which talks about their running average and changes for the 30-year money, 15-year money, and the 5-year ARM, which I think is based on a treasury. Okay, and you're going to see that it's like a stock market, and you're going to see all 4 of the charts going up and down, because that's what happens. And at the very bottom, it talks about rates, and it goes back to pre-1980, and you can see how that has been changing through the years, but the rates are still bobbling right along, as they will, because when we take a look at what the Feds are doing, the Feds, when they met, I believe it was in South Dakota late last month, 28th, 29th, I believe it was, they met and they have been discussing the option of, hey, should we pull back from buying mortgage-backed securities? Okay, and they decided that, yeah, we're going to taper, but we're going to make it really slow, because remember, that's one of the things that is keeping interest rates so low right now, because they keep buying those mortgage-backed securities that come onto the market. One, because it's an investment in you. Okay, well, that makes a lot of sense. But 2, it also helps to keep that economy going. Yeah, we're seeing a little bit of inflation. In some sectors, it wasn't as bad as what they had anticipated. It had tapered off a little bit. We've had some international issues going on. Yeah, that's a simple way to say it, which has had some impact on it. Consumer confidence, and different elements that they monitor are having some impacts on what we are seeing as far as rates. So we are still holding right about 3%. Non-owner occupied still holding at about 3.5%. Remember, 1 point is 1% when you're looking at loan fees or rate, and understand that those will be important numbers as you're looking at mortgage pricing. If you didn't watch the 5 questions you should ask a lender regarding mortgage rate, you need to watch that. It's a short video. We walk you through 5 key things you need to ask when getting quoted mortgage rates, so that you're comparing apples to apples. All right. So the next one, normal real estate cycle. Hey, some folks are saying, George, what's going on, dude? And I'm like, hey, relax. This is normal. This is our normal cycle. Yeah, we didn't see it last year, but we were stuck at home and we had more time. We were released. And so now we're seeing a normal market. And so it's funny how some people forget that there are normal real estate markets, and that's what we're in. And it will start to pick up, and it will start to pick up towards the middle of this month, towards the middle end, as people, start getting back into the mindset of, hey, it's time for me to buy a home. Okay. All right. Rates from now to the end of the year, they'll bubble around 3%. They may go down a little bit, they may go up, but we're anticipating that they're going to stay this way pretty much for the most part for the end of the year. So that, again, is part of that economic stabilization that they're looking at. Markets to watch. I've been getting a lot of questions as far as, George, I want to invest in, where should I be looking? All right, that's a really loaded question, and it depends on, it's like, your financial planning, your stocks, bonds, conservative, aggressive, what are you looking for? Are you looking for commercial? Are you looking for multifamily? Are you looking for development? Are you looking for equity build? Are you looking for income? I mean, there's so many different variables. So I decided, you know what? Let's scroll this back and let's talk about what are the 3 areas that you should be keeping an eye on, because we are seeing growth, right? Because the GMA, the Growth Management Act, a lot of municipalities and cities, I guess the city is a municipality, but anyway, are reevaluating their GMA. I know Snohomish County is in it right now. We've been watching that one a lot because of the going east of 45th is going to down to Highway 9 is going to be a point of growth because they're just pretty much out of land, and they need areas to prevent urban sprawl, which comes from Washington State, and they give the hey, here's what you need to do. and then they have to follow those marching orders from down to the counties and cities, so on and so on. Another area to consider, definitely Puyallup, especially now. Puyallup's holding off on some of the changing of zoning to create a little bit more density. I call it kind of the little mini Redmond. As it continues to grow, you have a really great demographic down there. Definitely something to to consider, to watch. With that, North Tacoma and the Ruston area. Okay, we're starting to see a massive shift into that core because it's been, well, that's a major city, but more importantly, it has been depressed for so long that now it is starting to evolve. It's so affordable, I should say, so affordable, but it's more affordable for developers, and we're starting to see that shift. We're seeing that demographic shift to increased values, and, well, it's just becoming a preferred area. Shoreline in some of those areas, primarily because of the light rail. There's a lot of things coming in. Shoreline has this big, I want to call it a kind of a walking area district. I believe it's a 6-block district that is going to be highly desirable. We've got a lot of folks that are looking at that for future development, future investment, like a buy and hold. Because of the light rail and because everything keeps pushing north and pushing south because of affordability, density, and what people can do. There you go. That's your market update. Super sweet, short, sweet, and to the point. Everything is, well, situation normal. It's all good. Everything is moving as forward as planned. If anything changes, guaranteed you're going to know about it. You hear about it here first. So make sure you subscribe. Have a fabulous 3-day weekend. I wish you guys all the best. And be safe. Take care.